guys, Mike here. So as promised, I'm going to present to you some data, and I'm telling you right now, it's some shocking data. I think it shocked me when I saw it, and I presented it to the members this morning. And I mean, it really is. It's stunning when you look at this. And I'm going to show it to you, but it'll show you plain as day why this market is moving up so hard, so fast. Okay, and especially the high growth stuff, right? And then of course I'm going to present to you the bull and bear case as plain as can be, and you can look at it and figure out which camp you're in. And then, of course, I'm going to show you a guy you need to follow on Twitter because he's called the Fed Whisperer for a reason, okay? And then we'll touch on earnings here because we got a big one coming up after and a couple big ones tomorrow. But here's the data this morning that just stunned me. And it says, this is crazy to me. Financial conditions have loosened so much, according to the Bloomberg Financial Conditions Index, that it shows that we are back to February 2022 levels when the Fed funds rate was at 0. And feel free to pause this. This is what they take in consideration as far as what they're looking at when they measure this and stuff. And it has to do with the yields, the TED spread, things like that, the VIX, swaption volatility index, things like that. But if you look at this, check this out. This is the Bloomberg's Financial Conditions Index, right? This is where we're at. And then if you go back, look at it, we draw a line over here. Look at where we're at. That's February. That's how much the financial conditions have loosened. And I've been talking about this, for at least a month, if not more right now about this. And another way to look at this right here is if we're above that line there, it's easing. If we're below it, it's tightening. Look where we're at. We are above it. And so we are easing, and it's been easing a lot. Okay? And so that is just mind-boggling. But another way to look at it is this right here. We're going to add the Fed funds rate on top of it. Look at the stair steps down at the bottom. That was when they were tightening, right? And you saw it, things got a little tight, right? Kind of traded sideways. And even with the last 3 raises, the conditions kept loosening, okay? And you can see right there where the arrow's at. That's where we're at now. And that's when we had 0 Fed funds rate. And this is after, look at this. This is going all the way back to the 70s. This is the federal funds target rate annual change. It was higher in the 70s, guys. Okay, that is mind-blowing. And then, of course, don't forget, rolling off the balance sheet too, even though as a percentage of the balance sheet, it's an absolute joke right now. You can see they ran more off in 2019 and 09, right? I mean, look at that. 5% versus 16% there versus 18% before. So they hadn't even begun to do it, but at least they've been doing it, right? And again, what have you seen happening, guys? You got the Treasury yield on the 10-year, boom, falling off a cliff. 2-year, not quite as bad, but still down 17%, right? You go over here and you look at the dollar, right? Boom, absolutely just been getting crushed, down 13%. And then here's something you can use in TradeView, the NFCI's, the Chicago Fed National Financial Conditions Index. And you can see right there, I mean, it has fallen off a cliff. And when we draw a line on this one, it actually goes back to April 1st. And so not quite back to February on this one, but yeah, that should show you what's happening. And so let me know down in the comments if that shocks you of how loosened the financial conditions have gotten. And I can imagine what the Fed, I assume they got to be looking at this stuff going, my Lord, like, well, what have we been tightening for? I mean, it's done nothing, absolutely nothing. And when you look at it, they really hadn't barely put a dent in the labor market, which is what they've been wanting to do. Look at Walmart. They just came out today and said they're raising their employees' wages. Good for you if you work there. Yeah, I wonder where they're going to pass that off to. You thought eggs were expensive now and milk. I guess they're going to pass it off to somebody, right? Everybody else is cutting labor. They're raising the wages. And so, that's going to be fun to deal with when you're going grocery shopping. But, this is why you see crypto and all these other ones, these high growth stocks, high beta stocks going to the moon because this is what they live by. When it's tightening, they're going down. When it's loosening, they're going to the moon, right? And it's not about fundamentals. It ain't nothing to do with fundamentals, okay? And with earnings this morning, what'd you see? 2023 guidance. Some companies raised theirs. Some companies lowered it. But there was no like, oh my God, this is an earnings apocalypse. This is terrible. There was none of that, right? And so, again, on the industrial side, things look kind of bad when you get out because there was some that came out today. It was just horrible economic news on the manufacturing side. But nobody cares. The market don't care, right? It is what it is. Yield inversions, everything else, whatever. Now does that mean we're not going to be coming way back down or we're not going to hit a recession? I mean, according to all the indicators, yes, like every indicator. But the market doesn't care about that. And earnings are coming in, okay, right? And again, we're going to talk about that in just a minute. And here's your, let me know which one of these cases or camps you're in if you're in one of these camps. Here's your like bullish case and bearish case. So most bullish is Tom Lee, right? He thinks S&P is going up 21.8% this year. He says inflation and Fed rate hikes peaked, soft landing, good for EPS, rare to have 2 bad years. Totally true. Bearish view over at Piper Sandler. They think the S&P is going to drop 17.3% this year, and then they think it's going to be bad liquidity, right? So lower PE, hard landing, lower EPS, and then hard landing not priced in yet. And if you're new here, please hit that subscribe button. Really appreciate it. And if you're getting anything out of this, please hit the like and think about sharing the video, guys. And so let me know which camp you fall in on that. The fun thing is, almost like both of them can be right? Like you can have a great first half of the year, and then if we hit a recession, it has to be a bad one. We have a terrible second half year. That's what people are trying to figure out. It's like you can have things happen. Like you see how much the S&P has gone up, right, just since the first of the year. And so, are things getting overstretched? Absolutely they are. But, if earnings keeps coming in okay, and the market just doesn't care about economic data and financial conditions continue to loosen, I understand why yields are coming down, right? It's because they're saying, hey, the bond market's saying there's going to be a recession. They can't keep raising rates. They sure can't hold them there. They're going to have to cut, right? Now, the bond market was wrong the entire year last year. So are they right now? Who knows? But the market doesn't care about that, right? It don't mind being irrational or rational. It does not care. All it looks at is financial conditions are loosening, we're going up. Financial conditions are tightening, we're going down, right? And sometimes they'll overdo it on both sides. You've seen that, okay? And so, again, let me know what camp you're in on that one. And so I think both of them actually have a good argument to make on that, by the way. But the guy you need to start following on Twitter and pay attention to, and let's start tracking him for sure, is Nick Timiraos. Okay, this guy is called the Fed Whisperer for a reason. He just came out recently this week and said the Fed's basically going to do a 25 basis point hike, and then they're going to start talking about when they finally pause rate hikes. And the reason why is because when the Fed wants something out to the public, because remember, they don't want to shock the market. I mean, I think we've seen this. They've been over backwards not to shock the market, right? They'll leak it to him because they can't come out and say it. And then he'll put an article out or something like that, or go on Twitter and stuff like that. And like when they were going to go to 75 basis points, people said no, and he said yeah, because I'm sure somebody in the Fed told him. I think he's some genius or something. Somebody's feeding him this stuff from the Fed, right? And then when he said it was going to be 50 basis points in December, people said no, we got to keep 75, and it was a 50, right? So he's saying 25. So if 25 does hit in February, I think something got leaked to him. If it doesn't, obviously they're not leaking stuff to him anymore. But, and they leak it to him again because they don't want to shock the market. So start following that guy on Twitter, and we'll see if he continues to be right because, everybody can be right in one year and then totally wrong the next year, right? I mean, Morgan Stanley was right all last year, and, I mean, obviously did a great job, Mike Wilson. And this year he's been totally wrong so far. Again, just in the first month. But he's, he's still out there saying, nope, we're going down. And we'll see if he's right or not. But, talking about earnings, I mean, this is where we're at, guys. I told you, bar is actually underneath the ground. But as you can see, S&P 500 IT sector profits are expected to shrink the most since 2016. And obviously, what's a big one going to happen today is going to be Microsoft. But tomorrow, what do you got to look forward to? Boeing, AT&T, Progressive, ASML, Hess, ADP, right? CSX, the big railroad, I believe they just put that contract with the union and stuff, so people get paid a lot more money. We'll see if they're passing it on to us. And then Tesla, which is what everybody's going to be paying attention to. And with Tesla, there's one thing to pay attention to on the earnings call, and then there's a bunch of things, obviously, to pay attention to, right? But one is this right here that I don't think it's enough talked about, but if he says on the earnings call to actually approve this, I can absolutely see this stock rocketing up.
The board is very open to doing a buyback, but I think it's like we just want to. It wouldn't be smart to do a buyback and then discover that the recession is like, I don't know, for argument's sake, worse than 2009.
And so we've seen what buybacks do for these big companies, right? People love it. The big firms love it. And he's 100% right, by the way. It would be ridiculously irresponsible to approve it. And he's sitting there telling you, oh, yes, there's going to be a big recession this year. They're planning it that way. But then to approve this, and all of a sudden they go into a huge recession and still have this stock buyback and then have to take it back. Or really, you don't have to take it back. You just don't use it, right? And nobody's really going to know. And so, but yeah, I mean, that's something to pay attention to. Obviously, they're building these factories. People are going to be paying attention to, are you going to be able to use that capacity to build these, cars, or is the demand there now that you've lowered the price and stuff? And, if you look at Google data or anything else, it is, because searches are way up for the most popular model in the world, which I believe is the Model Y. And so, that's something to pay attention to. But the stocks ran up a lot. And so we're going to get to see. And that's one thing people worry about with this earnings is stocks have ran up so much into the earnings. Like, if they do deliver good numbers, are we going to keep getting a push? Or is it going to be trade sideways? Are we going to trade down and finally, take a break? Hey, what's going to happen? That's really what people are looking at, because we are sitting in a lot of resistance on top of that. So, this will be the most interesting earnings season now, just because of where we're at in the market as far as the position we're in, this huge rally, this big run up, all this stuff. And so, a lot of people look at this like this is the Bears' last stand. If this earnings season comes out and people start raising guidance and all this stuff, and they just don't see this apocalypse happening, I mean, of course we're going up. That's just the way. That's the consensus. The way it's going to be, right? And so, and obviously, if the earnings come in horrible, how's the market going to react? That's what we have to find out, because nobody predicted Q4. They were talking about Q1. Remember, we're in Q4 is what we're talking about now. Q1 is what they keep saying things will get much worse, much worse. And so, people keep asking, where's the market going? First of all, nobody really knows. You can see that, by the way. Nobody really knows which way it's going. But you see, even the people who do this for a living, or some people are saying first half, terrible. Second half, good. And then they're flipping. Now go, wait a minute, well, maybe the first half is going to be good, and the second half is going to be terrible, right? And so, that's where we're at. This is to me, I don't know, let me know in the comments what you think, but it's one of the craziest markets I've ever seen. Just this last 13 months. I mean, my Lord, especially the last 4 or 5. It's kind of nuts, But again, we'll see. And I'm just curious to see, because the Fed obviously has access to all that data about everything loosening up, and they got to be seeing all the stuff flying off the charts right now. They got to see commodities going up right now. I can't imagine they're sitting there going, oh, this is great. I don't know, though. Again, remember, I still say, and I'll stick to this, and I could be wrong, it is what it is, but they are hamstrung, and this is one thing the bond market knows too. They are hamstrung into how high they can raise those rates. Because remember, you still have to service this massive debt we have in this country of $31 trillion. You still got to do it. Okay, and I've told you, they keep going up and they hold for like 12 months. It'll be the biggest line item on the budget then. That is, you cannot have that. You just can't have it. We don't have enough taxpayers to do it, and it'll really skyrocket that even more, which is insane to think about, right? But again, that's where we're at. We'll see again with that new CPI calculation. We'll see that's going to affect year over year. Shouldn't affect month over month. But the other thing we don't know is, with these commodity prices rising, how long is it going to take to filter in to the inflation data as far as it coming down, things like that. I don't know. Let me know if you know in the comments, okay? So please hit the like and subscribe button if you're getting anything out of this. I really appreciate it. And I'll see you guys tomorrow.